A big week in economic history, sort of where things go and kind of the decision at the crossroads that the Fed makes with respect to interest rates. I thought it'd be kind of interesting to provide a really quick recap in addition to what we covered yesterday about the Silicon Valley Bank and whole banking system. So, Silicon Valley Bank, second largest bank failure in U.S. history. Obviously, there's been a lot of quick responses to shore up everything and really fast changing landscape of mergers and putting together banks and liquidity and all that. So, basically, when interest rates were ultra low, Silicon Valley Bank invested most of its deposits into U.S. Treasury bonds with long durations, so 10 plus years to earn slightly higher interest. When interest rates started increasing last year, nearing the 1-year anniversary of the first interest rate increase, the value of these old bonds plunged by $15 billion plus, and it's very tight-knit venture capital community all tried to pull the money out at once. The spoiler alert there is that the bank couldn't meet all the requests at once, so a very unbalanced balance sheet. These rising interest rates have led to two main problems for banks that have failed to properly factor in this risk, because the value of their assets, basically bonds, commercial real estate loans, residential investment loans, investments fell as rates rose, and customers withdrew more cash from their accounts in favor of higher interest investments. So, definitely more interesting investment opportunities for idle cash as opposed to just being in a savings account. So with Silicon Valley Bank's failure, regional banks' financial stability has come into scrutiny as traders and depositors look to identify banks with similar balance sheets. First Republic's going through like that right now. UBS and Credit Suisse merged. Signature Bank is being ripped apart and sold off. So a whole different change of what's happening there. And basically, again, it's this mismatch of high rate of uninsured deposits, over the FDIC insured $250,000 mark in bonds with a long time to maturity. So it's a mismatched trade. First Republic had the third highest rate of uninsured deposits among U.S. banks after Silicon Valley Bank and Signature Bank. And so it's, completely in the spotlight. They did get a $30 billion injection of liquidity from 11 of their fellow competitors in the banking landscape. And again, the other big news there is Credit Suisse secured a $54 billion lifeline from Swiss National Bank. And on Sunday, UBS agreed to buy its rival for $3.2 billion. So, few people here have been through a couple of these cycles, 2008, the whole deal. Panic can be a self-fulfilling prophecy, which is why these governments are taking extraordinary measures to contain damage and move very quickly. The Fed kicks off its March meeting today and tomorrow. And Treasury Secretary Janet Yellen came out, I think yesterday, and said the U.S. banking system remains sound, and President Biden pledged to do whatever is needed to ensure America's banking system confidence. So there's a couple of takeaways here. It could go a few different ways. The opinion is divided on the tactics the central bank should take, and basically there's no longer an expectation of a 50 basis point increase, but either it's going to stay flat or go up 25 basis points. More or less, there's just two different pools of banks. There's the too big to fail, the JP Morgans, the Bank of Americas, the cities that are already seeing a spike in deposits. That people move their money to what is seen as these, very large institutions with credibility and liquidity and the backstops there, and moving money out of regional banks. I think, my 2 cents there is that we could see a lot more slow-moving regional banks on, the commercial real estate loans, just general loans and kind of liquidity there. And so, this is where private capital comes into play. I'll let Chris expand upon that in a second. Summarizing kind of where the Fed is and all this economic updates and interest rates, this week's Fed's meeting will present a conundrum for Chairman Powell and the whole team there at the Fed. The Fed has seen it's been a year of tightening financial conditions, draining liquidity from the system with the intent to pressure Main Street, thinking employers, consumers, retailers. But now our measures are putting pressure on the financial system. So basically, they have to decide whether to keep rates the same, just do a modest increase, or start pulling back rates this year and stop this quantitative tightening, completely, and potentially even start quantitative easing again. So not much else to add there. You can read into it. Basically, in terms of where we're seeing U.S. bonds are kind of all over the place. 2-year Treasury notes dropped 56 basis points last week. They're going up. Lower bond yields indicate investors may be worried about the Fed's next move. So it's looking like a lot of uncertainty in the system, coming into the end of the March and the first quarter here. So with all that being said, the exciting part for us is some news that came out this morning and where the market is perceived to go. A senior economist at the National Association of Realtors said this banking crisis could lead to higher activity in the housing markets. Mortgage rates could fall faster than expected. The Fed looks less hawkish. The housing sector reacts immediately to changes in mortgage rates. And so there's some evidence of that came out today. Basically, NAR came out and said they expect mortgage rates to come down to the lower range of 6% sometime in the second half this year, and now may get to that level in the next coming weeks, call it by mid-April. Kind of, putting fuel in that fire in a good way is February home sales came out this morning, and they were up month over month. So they increased from January to February by 14%, which is a pretty big number. The sale prices were 22.6% lower than they were a year ago, last February. In terms of actual sales of homes, is the first monthly gain in a year, and our largest increase since July of 2020. However, the median selling price is the first drop in 11 years, if you can believe that. So the median selling price of a previously owned home fell a modest 0.2% from a year earlier to $363,000 in February. So again, that's a 11-year run that just came to an end. The West out here saw the biggest drop in home pricing at 5.6% from a year ago. These sales were based on, actual closings. So the contracts were likely signed in December and throughout January when mortgage rates had kind of dropped back down. So obviously supply demand, you see that the consumer home buyer is responding very quickly, lower rates, and it makes a meaningful impact, especially on kind of the entry level to middle, median sort of home prices. The other big sort of factor that's out there is, sales may have been higher, but still extremely low supply, low inventory of homes. There were just 980,000 homes for sale at the end of February, and that's flat compared to January. So that's a 2.6 month supply of homes for sale. A balanced market, for context, is considered 4 to 6 months of supply. And then some other positive news here. All cash sales accounted for 28% of transactions in February, which is down from 29% in January. Again, just 1%, but up from 25% a year ago. And individual investors returned, making up 18% of buyers. So that's up from January. A little bit down from a year ago, but still in a positive trend upward. These properties that sold were on the market for an average of 34 days. So still a little bit more of a drawn out time period than kind of that, COVID impacted housing market of 2021 and 2022. Last kind of sort of interesting piece of information, shifting over to the SFR rental market report, is also very, very positive on SFR rentals, and definitely something to share with your clients that are out there. Adam, which is a big provider of fix and flip data, SFR rental market data, released its Q1 2023 single family rental market report, which basically ranks the US markets, that are best for single family rentals and worst. And for context, they analyze single family rental returns in US counties with a population of at least 100,000. So not in our smaller markets, but our bigger markets. The report shows the average annual gross rental yield on 3-bedroom properties, which is basically that calculation's gross rent income divided by purchase price, to be 7.5% in 2023. That's up from 6.7% in 2022 for the same markets. And the first time there's a big increase since 2019. Basically, yield increased in 91% of markets. And sort of the biggest markets in here were Detroit, which had the highest yields, then Cook County in Chicago, Cleveland, another county, Oakland, which is outside Detroit, and Palm Beach County and West Palm Beach in Florida. The Midwest and the South continued to outperform, and basically the West was absent from any sort of rental increases. That being said, Santa Clara and Honolulu had the lowest gross rental returns. So Santa Clara County is San Jose and the South Bay out here in the Bay Area. And basically Oakland was in there, Fairfax County, Virginia, and a couple other suburbs in and around Washington, D.C. had very low rental growth. So interesting report there. And then last, starting over the multifamily side is, CBRE, which is the big player in the industry, did a big sort of survey and study, and their latest economist projections show that cap rate expansions likely continue this year, but may peak later this year in Q3 and then start trailing off kind of in line with interest rate increases, and then hopefully flattening out of the interest rate and decreases towards the end of this year. The takeaway from all that is looks like the home buyer is coming back into the market with lower mortgage rates. There's increased activity from investors. There's pretty good updated data on markets and where people are buying and finding returns, and all very helpful to educate ourselves and our customers. Chris, anything to add on the banking and the regional banks and where there may be opportunity? Any of that? And the
That was
private
a
lending.
mouthful today, Mark. That you covered a lot in those points, which was great. I think the way to look at it, you mentioned, Credit Suisse. I mean, put it in perspective. Credit Suisse is being sold for essentially 5 cents on the dollar from what it was 5 years ago. So you sort of can see the impact of, of the banking crisis on an international basis, not just on a local basis. I think the other takeaway when you hear Mark discussing likely reduction in interest rates, I think the Fed has signaled a change in philosophy right now, which is the U.S. economy and the health of the banking system and the underpinning of all of its assets at this point is more important than worrying about inflation. And I think what happened during the with Silicon Valley Bank and some of the others that were under scrutiny is that we realized just how important the interest rate equation and rising rates, how much it affects the value of the assets. And with something we've been talking about internally about, how the consumer can't, the home buyer can't buy nearly as much as they used to when interest rates have gone up. Well, that exact same discussion as we've all discussed is happening on the commercial world. And when you look at the size of the just real estate assets on their own, when you start potentially revaluing assets 10 to 20%, to put it in perspective, the U.S. housing market is about a 25 trillion dollar market, right? You take a 10% adjustment or 20% adjustment to that. That's a lot of money that goes out of the system very, very quickly. And if it goes into a free fall, it won't be good for anybody. And then you look at the commercial market, which is smaller than that, but it's still a sizable chunk. All the asset values that we're talking about have been underpinned by very low and propped up by low interest costs. They rose so quickly that it was getting ahead of sort of the managing the inflation. And I think the Fed basically had to really look and go, wow, we could be in a real trouble if people lose total confidence. So that's really why we're seeing now that probably 6 months ago, we would say, yeah, we're going to see rates rise all the way through the year, maybe into next year, then stabilize. Now we're starting to hear, well, maybe they'll stabilize now, maybe one more 25 basis point increase, and then we're stabilizing. And by the end of the year, maybe see rates coming down, and then next year seeing long-term rates coming down. That will change the dynamic of a lot of our borrowers and of a lot of the investors in the marketplace, because it will take some of the uncertainty that everybody's been dealing with, and also probably put us in a position where we could see some asset values, sort of the bottom will likely be sometime in the next 4 to 6 months, and then we'll start seeing them rise again as rates go down, because now the consumer can buy more, and properties will start trading at a higher price for all those reasons that debt is constantly used to buy real estate assets, and if it's cheaper to borrow, that means values will go up. So again, this is one day into what was a tough couple weeks, and we'll see where we end up. But I think that's what's been signaled by the Fed and what we're seeing across not only the U.S. economy, but also the global economy.